Welcome, this is Richard. We're going to take a look at Dillard's department store today. I'm going to walk you through the Owner's Earnings Playbook, what we call the 4-minute drill. The 4-minute drill is, yes, I'm interested in this company, do further research, or no, I'm not interested. There's only so many hours in the day. This has really helped me a lot. The criteria that we use is cash flow from operations and the cash flow statement. These metrics in the cash flow statement, we think, give us the highest probabilities of winning over time over the large sample size. It's done very well by us. So let's get started. Stay tuned. Here comes the 4-minute drill on Dillard's. First, we have a buy, and very important is that it's a risk profile. We only make two distinctions here: conservative profile or speculative. If it's speculative, then the 4-minute drill turns into a 1-minute drill. So, but from there, they don't pay any dividends. What I like to do is take a look at the sector risk reward chart. This is the risk is enterprise value, what you would have to pay for a company, equity and debt, and the invested capital, what is invested in the capital in the company, in equity and debt. You can see here that Dillard's is right here in the middle. We don't like buying stuff way up here. Don't like to buy stuff way down here with no growth. Sorry about these others being shaded out, but we have subscribers. It wouldn't be fair to them. Hope you understand. So here, this is really what we're looking for in the risk reward in a sector chart. We look at the same thing in the industry, break it down a little closer. And you can see here, I think they're well positioned. They're 3.8 times invested capital, making 25% plus. Now, I will say this company over here is Amazon. I don't know what they're doing in department stores because they don't really represent consumer cyclicals, in my opinion. And they're not making shareholders. Anyway, that's a story for another day. But here we make an opinion on the fundamentals of the company. Are they positive or negative? And a technical opinion on the market profile, if it's positive or negative. Here it's outperformed the S&P by what looks like 5%. And one of the reasons I chose this because they made a filing last week. I mean, the filings are on our system the next day. So this is pretty fresh data coming out of the filings. They have plenty of cash flow to pay the dividend, except they're not paying very much of a dividend. But here's where we like to see free cash above earnings. And this free cash is growing good. The invested capital multiple we saw on the chart is 3.8, catching a 26% owner's earnings. That's outstanding. PE ratio 18. People are happy to pay 18 times earnings for this stock at $681. Now, the way we look at it, the cash flow coming through the cash flow statement is the price owner's earnings is less than 11. So here, I'm sorry, this is also shaded out, but Dillard's is 10 of 62 buys. There's 62 buys in this sector, and they're rated number 10. We rate them from high to low. And in the growth component, they're rated number 12 out of 62. So, and you can see here on this chart that the return on earnings has been coming down. Say net income's been coming down, but owners' earnings have been very steady through here and has actually picked up in the last 2 quarters. And you can see that in the cash flow from operations here and free cash in the last 2 quarters. And these get compared, Wall Street compares second quarter here to second quarter previous, third quarter here to third quarter previous. That's how they look at year over year numbers. Let's see, you can see that the company is clearly self-funding. The working capital is all in good order. Now here is a 5-year view of earnings, accruals, cash flow from operations, free cash, and CapEx. Now, cash flow from operations look pretty consistent. The earnings have been coming down, but as you can see, the free cash has been consistent and is going up here. One of the few companies making a great return without spending CapEx through the roof. Now, one thing I want to mention here is these accruals. I always like to look at these accruals. These are non-cash items. And let's go to AI over here. Now, this is what I'm not too interested about dilution in earnings per share. I don't follow net income and not much in the income statement. What I'm interested in is, as a shareholder, am I getting diluted? So when I bring this up, 5 years ago, they had 22 million outstanding. Now they got 15, maybe 16. This turns out to be what they call net anti-dilution because of the buybacks. So this is a 27% pickup. But what it tells me is the management team at Dillard's is their value base and will protect the shareholder. That's what I want to know in the footnotes. I don't need to go through 200 pages of footnotes to find out they've diluted earnings. What I'm interested in is shareholder dilution. So anyway, every time I come across this accruals that are up, I want to go to AI and take a look there. Now, the sales to invested capital, 2.6, this is great. They're leveraged 20%. It could be leveraged even more how successful the sales to invested capital ratios are. So, and again, we like to track the free cash to the dividend. They have plenty of free cash paid to dividend, but not really any dividend. So there you have it. That's our 4-minute drill on Dillard's. I hope that you will sign up for our website. I think it can help you. I think we can help protect and grow your wealth. Just consider this a risk management tool. It's like if you're driving your car, the oil light comes on, that's a risk management tool. You need to check something out. So this is really a stress test, if you will, a 4-minute stress test to see how your company's doing, and more importantly, how the story is doing versus reality being the cash flow statement. So hope you join us. That'll be it for today. Thank you very much. And remember, buy the good ones. Thanks.